Okay, well, hello everybody, and welcome to Mergers and Acquisitions Checkmate, brought to you by Davison, Eastman, Muñoz, and Paone, Focus, New Jersey, Manufacturing Counts, NJBIA Support Center, and New Jersey Business Magazine. I'm Wayne Staub, and I have the pleasure of being the Chief Business Relations Officer here at NJBIA. And with us today, we have Matt Blaine. Matt is a shareholder with the law firm of Davison, Eastman, Muñoz, and Paone. He received his BA and Juris Doctorate degree from Rutgers University and Rutgers Law School. Matt has over 15 years of experience in startups, mergers and acquisitions, as well as complex commercial litigation. He started his career as a litigation attorney, focusing on complex commercial litigation, and realized early that many of his cases we're working on ended in transactions, either voluntarily or negotiated through settlement or imposed by court or arbitrators. Matt's firsthand insight to the trials and tribulations of commercial litigation has helped him to collaborate with his clients, anticipating and managing their risk both before and when they arise. Over the last year, Matt has helped his clients close over $75 million worth of transactions, including acquisition, mergers, and exits. So I just want to go over a few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you along with today's presentation. So be on the lookout for that. But I'd also like to draw your attention to the question tab. Matt would be more than happy to take your questions. So get them in as you see them via the quick question chat box. So with that, with no further ado, I'd like to turn it over to Matt. Matt, take us away.
All right. Thank you very much, Wayne. And thanks for having me today. All right. So thanks for taking the time to join us today, everybody. Being an attorney, I just got to get through a little CYA and make sure that everybody's aware of this disclosure. The views here are just mine, shouldn't be attributed to anybody else. NJBIA or to my firm. This is a presentation solely for legal and educational purposes and doesn't constitute legal advice, and there's no attorney-client relationship or anything like that being formed here. So now that I have my butt covered, we'll move on. So we're here today to talk about mergers and acquisitions. And the theme that you're going to hear me focusing upon is planning to strategically start up and operate your business with an eye towards acquisitions and exits, along with a focus on selecting the right team to help you craft and implement your plan while adjusting to any issues that may arise before they become much bigger headaches. And this general approach tends to work pretty well for starting up, exiting, acquiring, or just for regular standard business operations. So just going to give you some brief background of a few of the things that we've done here recently and that I've been involved in. First one was an F reorganization with pre-structuring and converting 2 target companies into one, the largest of which was an S corporation that had converted from a C corp within the last 5 years. And I bring that up, and you're going to see that there's a theme where apparently I've dealt with a few of those recently. It's important to understand, particularly when you're having an exit or a liquidity event in relation to a business, what the tax structure and the tax classification of the business is. Because with a C corporation, it works pretty well when there's regular operations with things, and you may not be making substantial distributions or dividend issuance or things like that. But when you're taking money out of the company, you tend to have, there's the double taxation rule. So you have the tax at corporate level, and then you also have tax at the individual level. So the company gets taxed, and then the individual shareholders get taxed when they receive a dividend from the company when they're pulling money out. That doesn't work very well when you're trying to have an exit event. So oftentimes you'll see that a C corporation will convert from a C corp to an S corp. The problem is that there's a 5-year look back window where there's still something that's called the built-in gains tax, or the big tax applies, and there would still be double taxation there. So you have to make sure that you are working with not just attorneys, but also with tax and accounting professionals, whether it be a tax lawyer, whether it be a CPA or an accounting firm, somebody that on your team that has a strategy in place to help alleviate some of those taxation issues that would already otherwise arise if at the point of a liquidation your company is a C corp. So that was one of the issues that we dealt with respect to this transaction. So luckily we were able to find out, we did have some great avenues in terms of trying to alleviate some of that burden, which included, getting a valuation at the time of the conversion by an accounting firm. And then this was a services related business. So there was personal goodwill that we could attribute to the main principal. So by virtue of conveying the personal goodwill, we were able to avoid double taxation on those assets. So it just goes to show that there are avenues that are available. You just have to make sure that the team that you have put together and that you're working with to try to help you implement your plan is on the same page, and you're all working together to get all these things done in tandem to try to get the best possible result that you can have. And then we had, this is actually, ironically, this was my best friend growing up, and his family owned wholesale business down in South Jersey. They sold the assets of their operating company, which was a recently converted C corporation, and the real estate that was owned by an LLC. Again, the C corporation sale would have been an issue with respect to double taxation, but luckily before the business had ever really even gone onto the market, we were able to connect with some tax and accounting professionals who did a valuation of the company. We were able, at the time of conversion, we were able to understand what the likely tax consequences would be based on that. We didn't have any offers in at that time. They didn't come in for a while. Luckily, the offers came in above the valuation, which was a good thing for tax purposes. There was more than enough time in between the time of the valuation and the offers and the closing of the deal. And, we dramatically managed just through preparation, guidance, and making sure that we were ready to go when this thing got an offer and went to market. We were able to reduce the taxes that they otherwise would have had to pay on account of the built-in gains tax by a few $1 million. And as I said to my friend, when we were tailgating at an Eagles game, don't hold it against me if you're a Giants fan or a Jets fan, I told him shortly before the transaction that the best thing I did for him was not anything legally related in terms of dealing with the documents or negotiating or stuff like that. It was getting him in touch with the tax and accounting firm to avoid, to be prepared and to, dramatically reduce those tax liabilities. So, because there was nothing else that I could have done that would have resulted in savings like we managed to achieve there. And then we had another one, actually, and this is why when I'm putting this presentation together, I said, man, I've dealt with a lot of C Corp issues lately. I guess that's a topic that we'll talk about. We had two companies. One was an LLC, so you don't run into these double taxation issues. The other was a legacy C Corp that had not converted, but we took a bit of a different tact in this one to try to deal with tax liability which was by trying to go to market with an equity sale of the stock in the C Corp as opposed to an asset sale of the real estate. And oftentimes in real estate, people don't want to acquire, real estate's not really all that well suited from a buyer's perspective for a stock sale. So the buyer wanted it to be an asset sale, but because of the way that we went to market and because of the way that we negotiated it, my client negotiated it, we were able to gross up the purchase price to account for the likely taxes that would be incurred on account of the C Corp double taxation. The buyer understood, the buyer was fine with that. And even though it increased the purchase price, we were able to negotiate with the broker for the deal and ensure that the additional money that was coming in for the gross up didn't go towards the commission. So it's paying attention to things like that and to the strategy in relation to the entire team that you're using for an exit here that really pays the dividends. And, so in this example, it was the accountants, it was the broker, it was my client, it was the buyer. We all put it together and we managed to get a good result there. Another interesting tax issue that we had over the course of the last year or so was there was a real estate holding company that was an LLC that owned a multi-unit apartment complex where we had filed, and I still do complex commercial litigation as well. We had filed, a partnership dispute action over it. Through the litigation, we were able to reach an agreement in terms of, what was going to happen moving forward. And as we'll discuss later on, we were able to structure it in an efficient manner and to do, what we could so that it would essentially be, even though my clients were essentially at one stage, they would have been leaving. They actually never even had to leave the company. But they wound up getting the company's interest purchased by the partner that they had the dispute with, and managed to accomplish a tax-free 1031 exchange. We're going to defer those gains till later on. And again, that was something where I knew that I needed to bring in outside tax counsel in order to help me accomplish that. I explained it to my clients. They were fine with it. They wanted the additional expense was well worth the short-term savings and medium-term savings that they have as a result of accomplishing that strategy. Another example is I had a client recently that acquired the real estate and the assets of a daycare business through two different purchases, and just by paying attention to issues that arose in due diligence with respect to my client being the buyer, we were able to identify zoning issues, and well before we had to go to the closing, we went in and from the municipality got what's called a certificate of non-conforming use, where we were able to ensure that the pre-existing non-conforming use that the seller had for the property would carry over to my clients as the buyer of the real estate and of the daycare in two separate companies. If we hadn't done that, and if we hadn't identified that issue and just closed anyway, it would have been a lot riskier for them. And that's the type of thing that not a lot of people are aware is an option that you can have in relation to a pending transaction, but we took advantage of it. And although it did delay the deal somewhat, it was still something that my clients absolutely wanted to do. And, they wouldn't have been able to do it if we didn't have the right team together to help them in relation to the acquisition. And then, I've also done work with tech startups in the blockchain industry with funding rounds, seed rounds, things of that nature. So I'm pretty well versed there and have a great team of professionals that help me out with that. And other consultants. So it's kind of a unique practice that I don't think a lot of people in New Jersey have. And then we've also handled simple retail store asset sales from, pizza shops to Italian delis to jewelry stores. So it's not just, the 10, $20 million plus deals that we're dealing with, we sometimes get involved with sub 7 figures, thing of that nature. It's always helpful to have, a good team and solid representation on that, particularly when you're dealing with tax, and anytime that you get involved with small restaurant industry things, there tend to be, based on the nature of the business, certain disclaimers that you want to make sure that are in the deal documents, so you don't get caught, or your client doesn't potentially get caught with their pants down, even if it's not a problem. Which brings me to the final point, which this was a litigation that we were recently involved in, where we were representing the buyer of real estate and the assets of a business. The sellers had some material non-disclosures that they had made with respect to financial statements and tax documents. Certain operating expenses were not disclosed in those documents, and it ultimately resulted in a dramatic after-the-fact reduction in the seller's purchase price. So it's a good example of how to be very careful when you have certain business practices that might present an issue when you're making representations or warranties otherwise in relation to the deal documents when you're trying to do an exit or a merger with another company. All right. And if anybody has any questions, feel free to ask them. I'm happy to answer. I'd be happy to keep this a little more conversational to the extent that we can. While lawyers.
Hey, Matt, a question did come in while we were talking. You mentioned real estate and interest rates, overvaluation of property now. How does that all play in?
Are we talking about interest rates from an acquisition perspective, from a seller
From the real
perspective,
estate perspective?
Yeah. So, I mean, this is a typical lawyer answer, but it all depends, right? So, depending on what the financing vehicles are that are available to somebody as a buyer, you may or may not think that it's a great opportunity to purchase real estate, depending on what the short-term cost is going to be based on the current interest rate environment, because, Prime Plus is now around 10%, if not a little more. Which kind of gets close to just a few years ago what you saw with hard money deals, when you had hard money lenders funding certain things for real estate buyers. So it's something that you just want to be aware of, and you have to make sure that if you are on the buyer side, at least just from a practical business perspective, that the cost of debt servicing or something that the working capital that you're putting into the real estate, or that the debt servicing that you're getting from the lender plus your working capital, that you're going to be able to handle it. Otherwise, you'll be underwater immediately, and nobody wants to do that. And then you have to figure out another financing vehicle or an exit. So you don't want to become a distressed real estate owner shortly after buying it. I hope that answered the question.
Thank you.
Yeah, my pleasure. All right, so we're going to turn to just startups at this point in time. Just some things to keep in mind is have a plan for funding through whether it be startup investing, third-party financing, sweat equity, or a combination of all three. That actually, the real estate interest rate question, I think, was a good one, keeping that in mind, because you got to figure out how you're going to fund things in your operational costs and your carrying costs. Structuring, choosing the right entity and the right tax classifications. And again, that is not a fixed thing. That can change during the lifetime of a business. So you have to make sure that you're paying attention to that. Your organizational documents, which would be, operating agreements, shareholders agreements, things of that nature. As my late partner, Bob Muñoz, was fond of saying, as he taught me, and I sat in on a number of consults that he had with clients, was, if you look around the conference room table and you see everybody that's there right now, it's a good practice to assume in 10 or 15 years, you may not have the same cast of characters just because of what happens in life, whether it be some unexpected event, either a death or a disability, or somebody wants to leave, or somebody wants to stay, or there's a fight. You have to plan for those things when you're starting out. Otherwise, it can be a lot more difficult later on when it's unclear. You know, it's the whole concept of good fences make good neighbors, right? And then the last would just be, you know, which dovetails into it, which is buy sells and funding mechanisms, whether it be for life insurance or disability insurance and things like that. And, you know, it brings to the next point, which is you got to have a great plan and a strategy, but at the same time, you need to have a team of partners and professionals that you can grow with and rely upon. So whether that be an attorney, an accountant, insurance agent, a compliance consultant, a broker that's helping you sell real estate or business, or, you know, depending on the size, like an investment banker, you have to make sure that you're adjusting and growing your team and cultivating your team, both internally and externally. So they're there to give you reliable advice that is helpful and helps you implement your plan when you need it. And again, you have to refine and adjust your plan as it grows, because what you have on day one isn't necessarily what you're going to want to have on day 5 or 10, or excuse me, year 5 or 10, particularly when you're looking at an exit and, you know, you run into taxation and other issues and stuff like that. So moving on, the reason why starting up is hard is because breaking up is even harder. The difficulties often arise from unclear or incomplete organizational documents, which are complicated oftentimes by stakeholder disputes that are internal to business. And these can lead to poor and unintended consequences in business succession and tax. And nobody wants to deal with those issues, particularly when you're at a stage where you're trying to transition your role or your life in relation to the business to something else, whether it be succession, whether it be retirement, whether it be, you know, trying to figure out how you're going to get the pot of gold at the end of the rainbow so you can fund what you want to do with the rest of your life. You have to be nimble and you know, understand that the needs that you had early on are not going to be your needs later. And by not addressing these issues that we talked about earlier in your organizational documents, you can lead to a much bigger problem down the road. And by not structuring things the right way or not doing the right tax classifications, you can lead to bigger problems down the road. So keep a level head and know what you want, even when these things arise, and what's most important to you, because you can often achieve an acceptable and workable result for everyone, even in the most difficult of situations. You know, I've been involved in disputes where I never thought that we would see a resolution, but, you know, somehow you manage to get one that everybody's usually a little bit disappointed in those situations, but it's better than, you know, being stuck and having to spend all of your time and energy talking to me or other people at the firm about how we're going to be handling the dispute or litigating a case for you. You know, we always say that there's an opportunity cost to these disputes, and that's what you could otherwise be doing with your life, or you could otherwise be doing with your business instead of paying attention to these issues or talking to us, at least talking to us about, you know, how to resolve the issue as opposed to moving on with something that can help to grow or transition your business to the next level. And I want to reiterate, right, that it's never too late. So sometimes when we go through these types of presentations, if you feel a little like your house may not be in order, right, don't let that prevent you from acting. The inertia there can be the most dangerous thing. So even if, you know, you're at an exit stage, right, it's never too late. Even, you know, the family friend that I told you about that had the exit from their wholesale supply business, we had talked to them 5 or 10 years before the transaction about converting from a C Corp to an S Corp for that very reason, but they never did it. Luckily, we were able to develop a plan early on when the stakeholders knew that they no longer wanted to focus on business succession and wanted to focus on an exit. We were able to develop a plan to figure out a very workable resolution, regardless of the fact that they didn't, heed our advice 5 or 10 years before, and it still worked for everybody. And, we got a great result at the end. But it's important, again, to have the right team. The advice and reliability of your team members, both internal and external, is crucial. And if someone's not carrying your weight, be willing to reorganize the team if and when needed. The accounting or tax professional that has been doing the books for a business and tax returns for a business for 20 years may not be the professional that business wants to use when they're trying to work out a strategy to have a graceful exit. The same thing with the attorneys, the same thing with, with anybody. You have to make sure that the people that you're using have the role that you need them to be playing in relation to that stage that you're in with your business. But again, it's never too late. And if anybody tells you otherwise, I would say they're wrong. So we're going to go through some quick do's. Well, maybe not quick, but we'll do some do's and don'ts, which are going to, summarize some of the issues that we already talked about. Obviously, do develop and implement your team plan and strategy. Plan for and address the tax consequences of your exit or acquisition, right? If your business is what you're primarily intending on using to fund the remainder of your lifestyle after you get to the stage where you don't want to be working, you want to make sure a huge chunk of that is not if it doesn't need to be paid to taxing authorities, then you don't want to be parting with that. You need that in order to fund your lifestyle and to plan for the next generation or do whatever it is that you want to be doing. And this isn't, we're not talking about cheating taxes or anything like that. We're talking about making sure that you have a workable strategy that makes sense within the way that the tax codes and regulations work, that it achieves an optimal result for you. Do pay attention to the terms that you negotiate with your external team members. And that especially applies to brokers and consultants that are helping you market your business for an exit event. I have been involved in litigation between brokers and their clients, either over a situation where the client perceived that the broker didn't do enough, or where the client wound up deciding not to move forward with the deal for any number of legitimate reasons. A lot of times, if you just accept the boilerplate brokerage agreement, consulting agreement, whatever it is that professional is going to be giving you, you are going to generally be agreeing to things that if an unexpected issue arises and there's a problem with the relationship there, you don't want to be trapped in a corner. You don't want to be dealing with litigation over your broker after you've decided not to sell your business, you've decided not to sell your business to a certain buyer, or you have sold your business and you have some type of other dispute. You don't want to be in there. So again, make sure you pay attention to those, and you can rely on other people, like me, to help work that out and review those terms as well. Manage your deal risk. Your deal risk is in relation to the risk that you would have with if you're acquiring something with your seller, if you're selling something with your buyer, right? You want to manage those things through due diligence. You want to manage those things through disclosure. You want to pay attention to what it is that the documents say and what you're representing in those documents. If you don't, you can wind up in a situation where it comes back to bite you, and after the fact, you are paying back some of the purchase price that you were relying upon to do something else with. And that can come up in a few different ways, right? It doesn't necessarily just have to come up in a direct litigation. Oftentimes in these transactions, we see holdbacks, right? Where there's there's like a working capital holdback, or there's an escrow for certain things. If you're the seller, you don't want to see that money going to the buyer. You want to see that going to you. And, if you're the buyer, maybe you want to see that money coming to you, but, you don't want to be overly opportunistic about it either, I don't think. You want to strike a balance there. But again, there's also collateral risk that can be involved here. And when I say collateral risk, I mean, if you make misrepresentations about the income, about the operating expenses of a business, about the payroll, you may not just be running into issues with the buyer. You might be running into issues with tax authorities, with the IRS, with the New Jersey Division of Taxation. And, so if you're worried about some skeletons, then make sure that you're doing the best you can do to address them. And do that if you're the buyer from the due diligence end, or if you're, going to be the surviving entity, do that in a merger, do that from the due diligence end. And if you're the seller, do it from the due diligence end, and do it in relation to the disclosures that you're making, in relation to the representations in the deal documents, and in relation to what you're disclosing in due diligence. You have to be careful about that. You don't want to just gloss it over. Don't bury your head in the sand, right? Sometimes that can work. A lot of times it doesn't, though. And, you never know. I've had clients say to me before, it's like, well, I think it's worth the risk. And I said, yeah, in this situation, I tend to agree with you. But at the same time, if this primary risk that we're identifying, even though it's remote, actually arises in the next 2 years, you and I are going to be saying to you, wow, that was a lot riskier than we thought it was. So, you have to keep that in mind. It's all a matter of probabilities, and you never always know exactly how they're going to play out. And again, it's important, don't accept that limiting belief that it's too late for you to do anything. It's never too late to do something. You can always be prepared to address these issues. So we have some hypothetical situations just to go over. And again, if anyone has any questions here, please feel free to ask, because I'm just going to go over a few of these and give some options. So because I realized we had so many of these C corporation sales recently, so your business is a C corporation, you're planning for an exit event within the next 1 to 5 years, right? So what do you want to generally do in that situation? Obviously, as I said, you want to speak with your legal and tax professionals to develop that plan and strategy for how you're going to address it. As we talked, consider converting to an S corporation. But again, if you do, there's still double taxation issues associated with the built-in gains tax if the liquidity event happens within 5 years of the conversion. Obtain the valuation of the business as of the date of conversion so you can better understand your tax implications within that 5-year look-back window. And again, if the sale happens, if the liquidity event happens after that 5-year look-back window, you're not going to be looking at the double taxation. You would just be looking at, straight capital gains, essentially there. Also, right, consider an equity sale to help alleviate your tax liability. An equity sale, a sale of stock, does not have the built-in gains tax. Essentially, would not apply there. That applies essentially with asset sales. So that's another option. And again, we went through an example earlier where, while we were considering an equity sale, the fact that we were marketing it as an equity sale enabled my client to gross up the purchase price and essentially have the buyer pay for the additional cost that she incurred because of the double tax liability associated with the C corp. So even if the buyer doesn't necessarily agree to the equity sale, the fact that you're raising these issues and discussing them can help. Can help to alleviate that tax liability. Again, we talked about the gross up. Another option, right, is, and this is an option that you can have from the buyer perspective too. Consider giving rollover equity from the acquiring or the surviving company in a merger as part of the transaction consideration. Because if that rollover equity doesn't have a liquidation event within the 5-year look back window, that can help defer your gains and possibly avoid that double taxation. So that's a creative option that we've used in the past when we're representing the buyer or the seller, because it's a way to try to alleviate something. And if the stakeholders involved with the exiting or the company that's no longer going to exist after a merger, if those stakeholders are still going to be involved in the business that will remain, then having that rollover equity can give them skin in the game too, and it helps to align incentives. And then again, like we talked about before, do evaluate other tax planning strategies like personal goodwill assessments and conveyances. Those tend to work better with service-related businesses, whether it be insurance, medical practices. You don't really see that many of these deals in law because of the fact that nobody can own a law firm at least in New Jersey, aside from lawyers. But if you're a retail store, right, and you're selling a product, that personal goodwill assessment is probably not going to work as well, but there are still some unique facts where it can fit. But that's another way that you can try to avoid those consequences, or at least limit them. And again, model out, right, your tax consequences and hold back enough to make sure you can satisfy conservative estimates, because you don't want to be looking for finances or trying to work out a payment plan with taxing authorities if you don't plan appropriately. And again, don't just sell your business without considering any of these things, because the chances are pretty good you're going to have to deal with them later.
So Matt,
All right.
Matt, a question came in. What are the most frequent potholes in planning for an exit or a merger? We talk a lot about the planning. What are the most frequent potholes?
I would say they would be unclear organizational documents or structuring from the start, where you have people that may on an exit have different expectations, but there's not an enforceable contract that actually says what the expectations should really be. Due diligence risks, where there is something that is a risk with respect to the business and you don't properly disclose it or address it. Tax liabilities, again, is another one, right? You want to make sure that you understand what those liabilities are going to be. So those are some of the easier ones. And then again, you want to, if you're the seller, you would want to avoid having a big holdback. If you're the buyer, you want to hold back just in case something winds up happening. So,
thank you.
Yeah, my pleasure. So if you are an owner of a real estate holding company that's a partnership for tax purposes, some of the partners want to leave while others want to remain. You want to exit, but you also want to buy new real estate through a 1031 exchange. So what should you do? Again, we already talked about it. Speak to your team. Right? Evaluate the 1031 exchange implementation mechanisms. You can have a partnership distribution of the property followed by an exchange where the partnership distributes a fractional interest in the property, like through a tenancy in common, to the departing partner, who then exchanges it. However, the challenge of that is that you may not meet the held for requirement, which is that the property has to be held for productive use in trade or business or for investment for a period of time, and avoiding disguised sales rules. This next option in the same scenario may work better, which is you can redeem the staying partner's interest in the company, where that staying partner gives up their 40% interest of membership or shares, right, in exchange for a 40% undivided fractional interest in the property, which is like a tenancy in common. The staying partner who gets that fractional interest then purchases the company that partner left, then purchases the remaining fractional interest in the property from that company that they just left. And the company with the people that want to leave then purchases replacement property. That is a way to try to address the limitation that I talked about in the other scenario. But there's still other risks, right? You still have the timing between the redemption and the purchase, fair market value interest, things of that nature, which is why you need to make sure you're talking to professionals on these things. And if somebody wants to stay, the drop and swaps and the swap and drops don't work as well. But they may apply for other ones, which is for other scenarios, which is why you'd want to talk to your professionals. And don't just sell your partnership interests and use the proceeds to buy some new real estate unless you're ready to pay full taxes on your sale. And if you roll all of the proceeds into new real estate and there is a tax liability and it's not a 1031 exchange, then you're going to be in a pretty bad scenario in terms of trying to figure out how to fund those taxes. And here's the last one. You want to sell your business, but you don't have audited financials and you're concerned about some of your business practices and the accuracy of your financial statements, tax returns, profit and losses, and other financial documents. This is that scenario that we talked about early on and a little earlier. Again, consult with your team, and that's internal too. Make sure you understand what the risks are. Evaluate how you can try to address these if possible as soon as you can. Try to figure out the appropriate way to disclose them, right? And if you can, disclaim any representations that those practices would possibly get you in hot water with the buyer. Just disclaim them from the acquiring party. And that could otherwise be, you don't want to be in a situation where those representations are being interpreted as being false or incorrect. And if you're obviously the acquiring entity on the other side of the equation here, it's essentially, a 180 reversal. But you want to make sure that you're looking for those skeletons in the closet as the acquiring company too, because you don't want to wind up getting something that you were not expecting because you either would have paid less for it or maybe you wouldn't have moved forward with the deal. So, and again, make sure you have a proper paper trail of disclosures. But again, don't just ignore it. Because you can be in the situation we talked about where a few years later you wind up dramatically reducing the purchase price. And like I said, with taxing and things like that, there can be other significant collateral risk involved there. So I believe that is the end of the presentation at this point in time. If anyone has any more questions, I'd be happy to field them.
Yeah, we do have a couple, and Matt, I can't thank you enough. One obviously one size doesn't fit all, but thank you for covering a lot of the different scenarios. A couple of things that I've taken and you repeated is professionals, right? And we talk about it. Have your professionals, have that team in place, and planning seem to be, you can't keep your head in the sand, as you said. I do have a couple quick questions here. One is, what are the best terms I should seek from a broker consultant when I'm trying to sell a business?
So a lot of times folks only focus on, that's a good question, Wayne. A lot of times folks only focus on the compensation in terms of a percentage that a broker, consultant, or an investment bank would be getting on a deal. Okay. But like I talked about earlier, you want to make sure, here's another one, right? Let's say that you are selling the business and it's an installment sale, or there's some holdbacks where you may not get the full purchase price for 2 years, 3 years, 5 years, right? You don't want to be in the situation where you have to pay your consultant the full commission, essentially, when you don't have all the money. So, and if an issue arises where you don't get that money for whatever reason, any of the scenarios we talked about before, then you don't want to be obligated to have to pay the consultant a commission on money you don't get. So that's a pretty good one. And again, making sure that you understand, whether or not you're able to leave a deal and things of that nature, I think are points that people often ignore, especially if you just sign a boilerplate document.
Great, thank you. And Matt, you did cover some of this, and I don't know if maybe you want to touch a little bit more, but how can I best proactively protect myself from liabilities when selling a business?
I think just kind of following that general roadmap and don't put your head in the sand, right? And Wayne, it's not just a matter of your external team of your professionals. It's making sure that the internal team is on the same page. So the person that's communicating with those professionals or with a buyer about deal terms and negotiations is aware of what those risks are. You want to make sure everyone's communicating on the same page.
Okay.
A lot of we don't see that. And if you have serious skeletons in the closet and you're making representations that could be construed as incorrect or false, then you want to make sure that you're vetting those with your professionals also.
All right. Well, thank you. One last one. Early in the presentation, you mentioned Bitcoin and other sources. What's the future look like for those, I guess, is the question. And how do they play in with the merger and acquisitions?
I think we're going to be. My long-term view is optimistic. Essentially, as we work through some of the political and power struggles that we've been seeing, particularly in relation to President Biden vetoing, I forget the name of the bill, but that would have pulled back some of the SEC's or reverse some of its rulemaking authority in relation to financial institutions and digital assets. I think we're going to see a situation where there's going to be more of a standard kind of regulated market. I don't think it's going to work the same way that we exactly see traditional finance work now and traditional securities. But I see a future, and my optimistic view of it is that there's a future where you essentially can have real world assets that are verified in some manner through a blockchain ledger that is decentralized and everyone will have access to it. So you're not just relying on financial institutions with their private ledgers in relation to whatever money you're supposed to have in your bank account. I mean, you've seen some of that recently, some of those issues with,
right.
I'm trying to remember the name of the bank. It's not coming to me right now, but there's a bankruptcy fight that's going on right now where some bank essentially has gone into insolvency, and the information that they're supposed to be allegedly the information they're supposed to be reporting to other either intermediaries or other institutions that rely on the money that people are supposed to have in that ledger, they kind of turn that switch off allegedly. So when you see those kind of firewalls get put in place, it can be a big issue, because then all of a sudden you have somebody that doesn't even have funds at the group that is going bankrupt or insolvent. They're with a solvent, some type of a solvent institution, but because of the way things are interrelated and you can't actually verify what someone's assets are supposed to be, they don't have access to 5 figures of money, 6 figures of money, whatever it is, and that can put people in a really bad situation. So I'm optimistic. I think it is there. Granted, there's always bad actors. Like you have Sam Bankman-Fried. That
Right.
That wasn't that. I mean, that was a crypto fraud, but that was a traditional fraud that was done through crypto, but mainly through their own private ledgers that they maintained, with FTX and Alameda Research and the web of companies that they had. Where they were just taking money from their customers and betting with it and losing, and
Right.
they didn't get caught till later on. But the interesting thing was that when things really started to go weird with FTX, a lot of people all over the world that were paying attention to blockchain ledgers were able to see that almost immediately and see that there was movements that were going on. Whereas if that was a traditional bankruptcy or insolvency, that information wouldn't come out for months or years. But here you had it happening almost in real time.
Wow. Interesting stuff, Matt, and thank you. So that's all the time we have for questions right now. But Matt, I just wanted to see if you have any last words or thoughts you wanted to share.
That's all I have. I hope everybody got hopefully found this somewhat interesting, or at least was able to take home some educational content. And if anybody has any questions or would want to reach out, my contact information is all here on the last slide. Feel free to shoot me an email, and we'll see what we can do. And thank you very much, Wayne and JBIA. I appreciate the opportunity.
You're welcome. And we have had some people ask if they could connect with you through LinkedIn. So I'm sure that's fine, correct?
Yep.
So again, I just want to thank everybody. Don't forget, you will be receiving a recording of this via email sometime this week. Our next webinar is the connection between oral and mental health, which takes place on June 25th at 11. So feel free to sign up. So until next time, on behalf of myself and Matt, we'd like to thank everybody for being here, for your time. And again, have a great day and feel free to connect with us at any time. Have a great day.
Thanks,
Bye, everybody.